What do you consider before re-recommending a company in a Motley Fool service? How does this differ from the original recommendation? Well, one of our most valuable acts over the years, if you look at Motley Fool premium services like Stock Advisor or Rule Breakers or Supernova, all of which I work on, one of our most valuable acts has been, as it turns out, to re-recommend companies. So, for example, I might have picked Netflix in 2004 or Priceline in 2002, but all of a sudden in 2010, in the case of Priceline, I decide, hey, I'd like to re-recommend that again. And the reason it's been a very valuable act is because I think our internal numbers show, and anybody who's a member can just look at our scorecards because everything we're doing is transparent on those services, you'll notice that we have an unusually good habit of re-recommending companies that go on to do well. So, for example, in the case of Priceline, after it had already risen 8 times in value, I, for whatever reason, got into my fool head to re-recommend Priceline again. And just to be clear on that, it was, in fact, June 18 of 2010. A lot of people said, Dave, it's already up 8 times. What are you re-recommending that stock now? I'm happy to say that Priceline, since June 18th of 2010, is up another 553%, so it's gone up 6 times from there, which means that first position is up a lot at this point. By the way, I don't always get this right. I re-recommended the Container Store last year, and that has badly hurt. So it doesn't always work, but we do have a pretty good habit of doing well with our re-recommendations. So what am I looking at? There are a couple things I'm looking at. One is just that the company is doing well, and it is fulfilling whatever we said in our original recommendations. So, Keaton, that's something that's really important to us. A growing confidence in that company, its business, usually because we're re-recommending once a fair amount of time has passed. In most cases, we've been able to witness, does this management live up to what it's saying? Does its competitive advantage in its industry loom larger today than it did when we first recommended it, whether it was last year or 8 years ago? And so it is, I think, adding to our winners that is the critical lesson for re-recommendations. And so, yes, I tend to look at the companies that are doing really well and ignore the other ones when I make my re-recommendations. There is no hard and fast rule here, and there are going to be exceptions to any rule we ever make here on the Rule Breaker Investing podcast. So occasionally I have re-recommended a stock when it was down. Activision Blizzard worked out quite well once. Companies that have a large balance sheet, we just talked about that earlier. If you have a lot of cash on hand and your stock's down, I feel better about you than if you don't have much cash on hand, because cash is really permission to evolve into the future. If you have a lot of cash, you can screw up all day long as you're starting to realize you're screwing up and redeploying that money in R&D and getting ready for the future. So that's a big factor for me the few times I recommend stocks that are down. But usually the winners keep on winning, and our re-recommendations reflect that.
As always, people on this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Learn more about Rule Breaker Investing at rbi.fool.com.